G'day. Welcome to the Agricoach podcast for families on the land who want to grow their family's wealth and prosperity across the generations. I'm your host, Ben Law, and I'm the Financial Bloke. Welcome back to the Agricoach Wealth and Wisdom podcast. I'm your host, Ben Law, also known as the Financial Bloke. And today we're bringing you an essential share market update that you don't want to miss. In this episode, we'll be diving into the key trends and insights you need to navigate the current investment landscape, both in Australia and globally. Joining me is someone who truly knows her stuff when it comes to investing, Libby Newman, the Senior Investment Specialist in Strategy and Research at Vanguard Australia. Libby brings a wealth of experience and knowledge from one of the world's largest fund managers, Vanguard. We'll be discussing how major markets have performed over the past year, what's been driving those returns, and where Vanguard sees future opportunities and risks. We'll also touch on the ever-evolving tech sector and whether investors should be thinking about increasing their exposure to the US tech stocks, given the rapid advancement in AI. So grab your notebook because this episode is packed with insights to help you stay ahead of the game. But before we kick off, we've always got to keep the lawyers happy when it comes to investing, tax, or legal. And we need a disclaimer. So here we go. The information contained in this podcast is general in nature and for education purposes only. It's not financial advice. It's not legal advice. It's not tax advice. It's not investing advice. It's not any advice at all. No one should act on the information without appropriate specific advice for your particular circumstances. I'm a former financial advisor and choose to no longer be licensed, so I cannot and will not give you specific personal advice in this podcast. So now that we've got the lawyers happy, Libby, welcome to the show.
Thanks, Ben. Good to be here.
So, Libby, before we get into the actual nitty-gritty of talking about investment markets, which I really enjoy, could you just give us a bit of a quick summary on your background so everyone listening can get an understanding of who you are and why they should be paying attention today?
So, as we're recording this, I'm actually in Melbourne, where I've been for the last 20-odd years, but I actually grew up in Queensland in Dalby, which might be familiar to some of your listeners. Got a few friends who had a farm out at Wallumbilla. My dad actually started life as a farmer and then decided he didn't want to be a farmer. He actually wanted to be an accountant. So he ended up being an accountant for farmers. And I went to university at QUT in Brisbane and did an accounting degree. And I think he hoped that I would return to Dalby and take over the practice. But I met my husband and I stayed in Brisbane, and then eventually we moved to Melbourne. So that didn't quite pan out how I'd liked. Now I work at Vanguard, which is one of the biggest fund managers in the world. And my role is basically to act as an interface between our economics team, and we've got 70 people in the overall investment strategy team at Vanguard, 10 of whom are focused on economics. And a lot of my time is spent just talking to financial advisors about the thinking that is coming out of our investment strategy group. And that can be a whole range of topics. I know we're touching on today the markets and the economy and a few different things, but they've also done some deep dives into mega trends that we've seen over the last couple of years. And we'll touch on one of those today about AI. How Australia retires. There's some research. There's a big body of research we do around retirement as well. So yeah, it's really great. I get to talk about a whole range of different things, and probably most importantly, how people build portfolios and can build their wealth over time. And that's something that when I did that accounting degree back in the 90s, that I really wanted to be out there helping people build their long-term wealth. And now I'm in a job that really helps me do that every day. So I love it.
Yeah, fantastic. And look, back when I was a financial advisor, we used to heavily use Vanguard. And also, I still to this day, one of the things I love about Vanguard is the educational and research information you do provide to the public. I'm always on the website looking at market updates. I love the investment charts, the live investment charts, so you can see what markets have done historically, etc. So that's one of the really good things. And I think Vanguard, one of the values they add to the community as a whole is they are able to educate people on making better financial decisions, because when there's better education, we get better outcomes in this space. So I suppose where I want to tip this off, because I deliberately didn't have a look at the last economic update from Vanguard, knowing this was coming up, because I wanted to come in completely like a novice for the last couple of months. Now, can you just give us a bit of a rundown on how the major investment markets, and probably the US and Australia is probably the two we're looking for, how have they returned over the sort of last 12 months or the last few years?
You might recall a couple of years ago there was a contraction that we saw in both the bond and equity markets, and that was a pretty painful year for a lot of people who are exposed to markets. Since then, we've actually seen a pretty strong recovery in both the US and the Australian market and global markets more broadly. Probably more particularly in the US markets, we've seen, I think this year, if you're looking at it on a hedge basis, we're up around just over 20% over the year. The S&P 500 is around 20%, so you can see that a big part of that has been the US market. These are data points to end of August, because we're recording this late September. So the Australian market's up around just under 15%. So again, pretty strong, not quite as strong as the global markets. And bond markets, which again was the epicenter of what we saw in that 21-22 period, where we saw probably a once in a 200-year contraction in those markets. It was the biggest contraction in that market that I've seen in my lifetime, and I've been around the bond market probably for most of my career. And so we've seen pretty strong recovery in the equity markets since that point, and that's tracked through 2023 and continued into 2024. And so it's interesting, if we look at that US market, and you can look at it a couple of different ways. The US market, the standard index that most people would look at is, I guess, the S&P 500, which is market cap weighted. So that means that when those big stocks go up in value more, then they get a greater weight in the index. And you can compare that to what S&P also does, an equal weighted version of the index, which basically means that the big stocks have the same weight as the smaller stocks in the index. So if you look at that, that really highlights that 493 of those stocks are really tracked what we would assess as fair value and are tracking along, I guess, what would we assess as pretty reasonable value for the stock market. And 7 of those stocks, which have been dubbed the Magnificent Seven, have actually delivered outsized gains. And there's some reasons for that. A lot of those stocks are technology adjacent. So the euphoria that we've seen around AI and technology, and particularly NVIDIA, I think has probably been the poster child for those really strong gains that we've seen. So there's the euphoria around AI, but the other thing that has happened that our economics team did a bit of a deep dive on a little while ago was that those big tech stocks, not only have they benefited from that euphoria, they've also been insulated to some degree from the rate hikes that we've seen. So we've seen, rates track from near zero up. I think even with the rate cut that we saw in the US, we were up around the 4.75 to 5% level. And so back when we were close to zero, a lot of those big companies were actually able to lock in their funding for a pretty long time. And they actually have much better access to the capital markets, and they use the bond market in the US a lot more than banks. In Australia, a lot of companies just go to the big four banks, and a lot of the relationship in terms of funding the debt side of their business comes from that banking relationship. In the US, a lot of companies use the bond market. And so when funding was super cheap in the bond market and available, those big companies had much better access to the bond market and could essentially insulate themselves from the rate hikes that we've seen probably for a good 4 or 5 years. And the other thing that they had the benefit of is that they had probably bigger piles of cash than a lot of those smaller companies as well. So they were benefiting from cheaper funding on the debt side. They're earning more on the piles of cash that they'd accumulated, particularly during COVID, and they had strong earnings. So if you take that into account, they're not as overvalued as maybe some people think they are. Yeah, that's just a little bit of a deep dive. I know I've sort of gone on a little bit of a tangent there, but I thought that was really interesting, that analysis which shows what's been going on in those big tech stocks, which have really been driving a lot of the returns that we've seen.
Yeah, that's really fascinating. So would you say then, because the US market, or those big Magnificent Seven, or a fair few of the US stock market, are actually accessing or have accessed that bond market money at cheaper levels, is that going to be a bit of a handbrake on Australian companies? Is that's why we haven't seen the return come out of the Australian market, do you think? Because the Australian companies don't access it as much as, I'm guessing, as the US does.
You've worked bloody hard to build a profitable, scalable and well-run operation. But now, as your children are finishing their education and starting to take an interest in the family business, you're realising it's time to shift focus. It's no longer just about farm prosperity. It's now about family prosperity. You need to align your family, start preparing the next generation, improve communication and strengthen family relationships. Now, of course, that's easier said than done. And that's why we created the High Performing Families Workshop to guide families through this crucial transition. Want to know more? Head over to www.agricoach.com.au/take action. Now, let's head back to the episode.
Yeah, structurally, our market is quite different. Like, I think the analogy is that we're a third debt, a third dirt, and a third other stuff. So a lot of it is banking related. So if we look at the Australian market over the last little while, the financial sector has been one of the, I guess, the best performing sectors. AREITs has also done pretty well over the last year, although it's had a bit of a rocky road. It's had some steep downs and some steep ups as well.
So that's real estate, just for anyone who's listening. AREITs is your listed property on the stock market.
Yeah. And so that's got shopping centres and office. It's not just, and probably industrial properties gone quite well in that sector. It's pretty concentrated in Australia, but the banks do have access to funding, reasonable levels of funding themselves offshore. So it's a little bit different in that regard. And probably, the bigger companies do also have access to funding. Like I know they also access the bond market. So it's a little bit different structurally. But yeah, that's possibly a handbrake. Actually, from a forward-looking standpoint, what we see is that because you've had those strong returns already from the US market, our expectation, and we at Vanguard, we don't pretend to know what's going to happen next week or next month. We're really quite measured in our outlook, and our short-term outlook is like a 10-year outlook, whereas for most people that's a long-term outlook. So for us, 10 years is short-term, and probably our 30-year outlook is a longer-term outlook. So when we look at it over the long term, given the starting point that we've got, particularly from the US, we're probably expecting weaker returns from the US market for the coming decade, just because we've had some pretty strong returns over the last couple of years.
Because it goes back to the average, sort of has to regress back to that mean return.
Yeah. So when we look at tying the markets back to the economy over the long term, the markets sort of track relatively closely what's going on in the broader economy. But from week to week and the month to month, they can overshoot and undershoot. And we see that happen a fair bit. But we see that, a long-term average probably going to be, in terms of forward-looking returns, is probably a little bit lower for the US markets. I guess our median expectation for the next decade is around 4% versus Australian equities at sort of 5.5, 5.6. So, yeah. Basically, we're not expecting the US to be the engine room of global markets moving forward. Not as much as it has been.
Okay, interesting. So, obviously the Magnificent Seven, as you call them, that's those tech companies like Nvidia and Apple, and I think Tesla's in the middle of that as well, is they've been driving a lot of the returns. But when you look at all the other companies, they've just been going on sort of just doing okay, I suppose, an average. And so we're expecting that a lot of money or a lot of capital's flowed into those Magnificent Seven. We expect that to possibly slow down over time.
Yeah, I think to sustain the current level of valuation that we've got there, we'd have to see, magnitudes of earnings that we've not seen before. So I think there's a lot priced into those stocks at the moment. It's not to say that AI is not going to deliver. We're actually quite positive from an economic standpoint. One of the other things the econ team has done a bit of work around is just, could AI be that transformational technology in the same way, well, maybe not quite to the same degree as electricity in the early 20th century, but could it be closer to being that transformational technology relative to computers? And I guess that technology was important and, boosted productivity as well, but it wasn't as widespread and transformational as electricity. Like, I guess our chief economist in the US, Joe Davis, has been doing a few talks on this, and he has some anecdotes about electricity being transformational, not only in manufacturing and the efficiencies that it brought about there, but also there's other impacts. I guess you had impacts on health in the sense that you had electric lighting that was in street lighting. So that meant that the streets were safer. You had, you could probably operate in a hospital at night time, whereas maybe you wouldn't be able to do that previously. Education, like you'd be able to read under a light at night, and it had impacts on education. So it really changed the way that we live and work. It's quite transformationally, as the name would suggest. So we think that AI has the potential to do that, and probably there's a whole white paper around this. If you're really interested, there's 33 pages that our economics teams put together, but they've had a look at like the 800 jobs that have come up in the general economic standpoint. I think there's economists generally probably think that it's just going to be same for the next decade, or maybe the next 10 to 15 years. Our economics teams had a bit of a closer look and thinks that probably the most likely outcome is that we see really transformational things happen. And I think people are probably pessimistic and dystopian, thinking AI is going to, change and take my job away from me. And at the other end, it's not going to really have any impact at all. And I think, things like food service or making a sandwich at the cafe, I don't know that AI is going to take over those types of jobs, but it's probably going to have a power tool effect, I guess, in terms of augmenting what people already do, or doing it differently, or people figure out how they use the technology to do their current day-to-day job differently as well. So there's there's an investment that needs to happen before that, and that's, I think, what we're seeing at the moment. And I think there's some euphoria around that. And then there's, I guess, the retooling stage that happens, and this is what's called the J curve. So there's a retooling and a lot of investment, and you may not necessarily see immediate returns on that investment. But then eventually you do see that it really is supercharging what's going on in the world. And I know a lot of this sounds like it may not be relevant to, what's going on the farm, for instance, but my brother-in-law actually works as an industrial designer in Brisbane, and he was telling me last time I caught up with him that there's some technology that he's been or a company that he's been working with technology-wise, and they're using AI to identify weeds that might be in crops, and therefore they're able to really, hone in and deliver to treat those crops. And in another sense, I guess they can identify what's good in the ground and what's bad in the ground, and treat and, get rid of the baddies and help the goodies grow better. So I guess, it's not just that we're seeing transformation technology in terms of ChatGPT helping you be able to write an essay or something. It's really out in many parts of the world and transforming medicine and technology and, healthcare as well. So there's a whole range of implications beyond just using ChatGPT to help you write something.
And I think it's one of those things that when you get a transformational technology, if we go back to the motor car, for example, I remember reading something years ago that in New York, in the early 1900s, they had a horse shit problem. There was so much horse shit in New York that there was companies that just was picking up horse shit, shoveling it and getting rid of it. And horses became a major problem for New York City now. But then within a few years, cars came in, replaced the horses, and next thing, that exponentially changed things. And the person that went around picking up and shoveling horse poo lost their job. But then a whole new lot of jobs come up. And I think for me, I look at this and I go, this will absolutely be transformational in every way. And there are going to be winners and there are going to be losers. And that's just the way it happens as we adjust. And depending on the speed of that change will determine how painful it is. And agriculture is a great example, because I think maybe 100 or 200 years ago, 98% of the population was employed in agriculture. Now it's less than 2%. But that happened over a long, extensive time. Whereas with AI, I'm not sure how that will happen. And I think that's why the whole index strategy is quite an interesting strategy for reducing risk, because you either have to invest in individual stocks and work those stocks out, or you invest in an index. So just for everyone listening, because not everyone will know what an index is, can you just give us a really quick summary on the difference between, say, investing in just specific stocks and then investing into, say, an index?
So I guess this is one of the things that I've learned along the way in my career. You can spend a lot of time, a lot of people are quite interested in picking the specific companies within an index. So in the Australian context, I guess you can figure out whether you're going to have BHP, NAB, like which of the big four banks you might have in your portfolio, and then other stocks that you might have in there as well. Or you can invest in the entire ASX. So Vanguard offers funds that they invest in the top 300 stocks in the Australian stock market. So that's the biggest down to about 300. There are stocks that exist beyond the 300, but they tend to be a little less liquid. And so I guess the power of investing in an index fund is that you're pretty much guaranteed that you're going to be invested in the next big thing, whatever that is. And for equities, that could mean that that share can go up. Like everyone's after the proverbial 10 bagger, or you can have the 100 bagger even, like in the case of NVIDIA, you've definitely got that. So in an index, you're pretty much guaranteed that you're going to have those stocks that are going to do super well. And yes, you might have those stocks at the other end of the spectrum, those stocks that do less well, but the return impact of those smaller stocks, or the ones that go a little bit pear-shaped, is infinitesimal compared to the gains that you can get on those stocks that do really well. And if we look at it back through history, the markets do tend to go up more than they go down. They do have episodes where they do go down and adjust, but by and large, I think we've been making record highs recently. So stocks continue to make record highs. Indexing is basically, I think Jack Bogle, our founder, put it really well. It's like you can spend time looking for the needle in the haystack, or you can just buy the haystack. And so to me, indexing is one of those life hacks. It's like, you can invest in the whole haystack and you're pretty much guaranteed that you're going to have the next big thing in your portfolio. It's just time efficient.
It is, yeah, and also skill efficient. So the example I'd always give, Libby, to people when we were talking about the difference was if you got someone that came out of, say, Brisbane or Sydney and they were a surgeon and they were a really, really skilled surgeon and they decided they wanted to invest in a farm that bred cattle, and should they actually go up and buy that farm and then on their weekends go up there and try and draft the cattle, put the cows? It's a whole new learning curve that's completely outside of your expertise. And for some people, they want to do that. They're in Brisbane, they want to go out on the weekends, they want to run their farm, they want to learn about cattle, they want something to learn about. And so those people want to invest. Others go, well, look, I want to invest in the market, but how about I just get the average? So instead of trying to breed the best bull and then trying to get the best price, just get the average from the sale when you don't know what you're doing and getting comfortable with that. And that's what the indexing is. And you're never going to be the number one winner in the race, but you're also never going to be the loser in the race. And I think for people, when their full-time gig is being a business owner, a farmer or whatever, and they're going to invest, trying to learn a whole new skill set. Because, I look at Vanguard, how many economists or investment research specialists are there at Vanguard around the world, roughly?
Oh, good question. I know in our investment strategy group, there's 70-odd people, investment specialists. So there's probably
hundreds.
Yeah, hundreds.
So there's hundreds of people that just full-time study this stuff and they don't always get it right, do they?
No, but probably beyond Vanguard, there's a whole range of people who sort of what we call active management, who are really trying to pick what stock is going to win. And they probably have, like from a ratio, because in a previous life before I joined Vanguard in 2021, I actually rated a lot of active managers. And it's a much more labour-intensive process to actually go through and figure out which stock is going to do well. And so probably rough and ready, I would say those types of firms probably had 3 or 4 times the number of people devoted to figuring out which stock is going to do well and which stock is not going to do well. And if you look at it from a universe perspective, like essentially what an index is doing is harnessing the intellectual property of all of those active managers who are, working away, look at the balance sheets and looking at the P&Ls and figuring out which stock is going to do well. Essentially, an indexing is harnessing the power of all of their intellectual property and serving it up in a really efficient and typically pretty low cost way. So we're not paying the salaries of all of the rest of the market and those people who are trying to work out those things. So we're able to deliver the index returns pretty efficiently. So it's interesting. When Jack Bogle started the firm, is literally 50 years ago to the day almost, where he started Vanguard. And I think for the first couple of years, the rest of the market sort of said, "You're crazy. What are you doing? Like, who wants to be average?" Until a few years later, they realised that actually they were being beaten by this strategy and that being average for a long time is actually better than being a winner one a year and being a loser for the next 8.
And what was Tony Robbins famously said, consistency is what turns the mediocre into the excellent. And I mean, if you talk to most farmers and you say, do you want a cracking year this year and then a terrible year for the next two? And every single one of them will generally say, I just like an average year every year. And I think that should be the goal for most people when it's investing. So with regards to the markets, one of the things you mentioned there was that there's the potential, a bit of research is showing we should be getting a bigger return out of Australian equities, or potentially over the long term, the next 10 years, than we would out of the US. That sort of goes contrary to my brain thinking Australia has no real exposure to AI, the US does. What do you think from the economist's point of view that in analysing this, what do you think the reason is for that?
In that scenario, it's probably more around the starting point. So I think your starting point is quite important in terms of what's going to happen over the next couple of years. So because we've had those couple of years, or probably, if we look back even further than that, we've probably had some pretty strong decade. I mean, I know in the early 2000s we had sort of a lost decade of the US. It didn't really go anywhere at all, and you're much better off being in Australia then. But I think even if we look at it over the last decade, probably the S&P 500 over the 10 years, you've had 16% relative to the Aussie index at 8%. So you've already had your cake in that sense. And so you can't continue to eat that cake because you've already had good returns out of the US. So that's probably partly the logic. Like you've already baked in some of those good returns. We don't expect that that's going to continue, I guess, in an angled line, ad infinitum. We think that because you've had those decade of good returns, that we're a little bit more circumspect that you're going to have a continuation of that. Like if we look at the long-term averages, like I guess, we'd probably expect 5 to 7, over a really long-term time period from an equity market. And so because we've had a pretty good decade from the US, not necessarily expecting that, you're going to shoot the lights out. But when we think about that from a portfolio construction standpoint, the Aussie market, both in bond and equities, is only 2 or 3% of the global market. So we're not saying that you need to be overweight Aussie equities at the expense and just ignore global equities. We still think that there's certainly a case for having exposure to as many eggs in as many baskets as you can in countries around the world. It just might be that might come from Europe or other parts of the world and not necessarily from the US in quite the same strength, I guess, that we've had over the last decade.
That was from a US point of view. What are we looking like from a total world point of view? What are the research showing for, because the US is a fair chunk of the world's markets, but when we look at right across the world, so the developed, the undeveloped, Australia, everything, what's the expectation in that area, Libby?
Yeah, interestingly, the emerging markets, which is probably, we have an allocation to the emerging markets in our diversified funds as well. And so that's probably a market that, if we look at it from a valuation standpoint, is looking a little bit cheaper versus the US, which is a little bit more expensive. The emerging markets, I guess, has been a tricky one because it has looked cheaper at periods of time before and not necessarily delivered. So I think that's an area from a valuation standpoint which definitely looks attractive. And I guess, India and China have capacity, notwithstanding that China probably has some things that they're working through at the moment from a property market and economic standpoint. They're probably two markets that have the capacity, I guess, to deliver some outside returns. Yeah, other markets outside the US. The US is just very large and influential in that global, so you can't really ignore it. But at the margin, I think, emerging markets is probably one of those markets which looks attractive at the moment, but also tends to be a little bit more volatile than other equity markets. So I guess I tend to think of it in terms of level of spiciness. So if you want a little bit of extra spice in your portfolio, then certainly has the capacity potentially to deliver outsized returns, but you've got to be prepared that some of those markets can be up 80, down 60. So you've got to be prepared to stomach that.
Yeah. And so from a volatility point of view, because one of the things that I've looked at when I've looked back across at the markets, we've seen an intense amount of volatility over the last 10 years, say. But then when you actually look back to, say, from back to 2014 and then 14 back to 2004, when you actually go look at the charts, we've had exactly the same amount of volatility. There was COVID, then there was, there was GFC, then there was the tech wreck back in 2000, then there was a bond market correction in 1994. Like, there's always been volatility. Are we expecting going forward more volatility or less? Like, what's the sense around that?
Another good question there. I think in terms of volatility, we experience episodes of volatility. So as you said, we've had that period. And I think in early August, we saw a little bit of that again. There was a little bit of volatility in the equity market and around the Japan carry trade as well. And that's a period, when we're building portfolios, we're thinking about those periods of volatility and what is going to work for you during those periods of volatility. So what we saw in early August and what we build our portfolios around is that bond markets, which don't make the 7 o'clock news, like Alan Kohler doesn't really talk about them all that much on those periods on the news, but it's actually a bigger market than the equity market. And so government bonds tend to benefit from a flight to quality when you have those periods of volatility in the equity market. So when you have risk assets, which is in my mind equities, drawing down, then oftentimes, and not always, because we didn't see this in 21 and 22, but oftentimes you will have something like the bonds offsetting that. So it really helps to, I guess, smooth the ride. And I think we were discussing earlier that sort of helps you stay the course over that investment journey because you're having less steeper climbs and deeper dives. They're sort of muted a little bit more by including bonds in the portfolio. So that's, I guess, something when we think about volatility and you look at the VIX index, which is a measure of volatility that people often look at. Certainly we've had bouts of volatility and almost, I think we went through quite a sustained period when there was pretty low volatility, and that almost worries me more than periods when you do have high volatility, because it's like, something's going to happen, but you don't know what it is. We didn't predict COVID was going to happen and we didn't predict the volatility. You just know that it's not going to last, that you're not going to have those periods of no volatility. Actually need volatility for opportunity. So, yeah.
Yeah. And every 7 years on average, I remember it was like we need to see a correction. Like that's just naturally what happens. And if you go back through the charts, you can see all those things happening. And I think it was Warren Buffett, I can't remember. There was more money lost waiting to try and time the market when to get in, waiting for the perfect time than was made by investing at the worst time. And it's quite often the time in the market, not timing the market, that's going to give most of the success. And people seem to invest so much time worrying about which stock to buy, when to buy it, and all the perfect times. Now, if you're a share trader where you're buying and selling and trading every day or every week, fair enough, go have at it. But for the average person, that's not what they want to do. And so I advocate for people is if you're going to invest, get in early and time will smooth out a lot of the volatility. And I gave someone the example the other day. They bought a property, a cattle station about 30 years ago. And I can't remember the numbers, but it was like they paid $1 million for it. And they overpaid by about $100,000 back in the day. And they were, we've overpaid for this. Now, 25, 30 years later, it's worth $40 million, the property. And that $100,000 is insignificant. And I think it's the same with investing. If you can get in early, get invested, there's going to be ups and downs and you might time it perfectly, but 10, 15, 20 years down the track, it's going to have paid off tenfold.
And I think the analysis that we do shows that, oftentimes the best and worst days can happen really close together. You can have those episodes of volatility and big market swings. Half the time you can have, some of the worst days to be invested happen in the best years from an investment return perspective. And likewise, some of the best days happening in the worst years. So there's not necessarily any rhyme or reason around when is the best day to get in. It's just, as you said, it's about time in the market, not time in the market, ING. The market, that's extraordinarily difficult to do. Great if you can do it, but it's extraordinarily difficult to do. So your next best bet is to just stay the course. Stay
the course and invest in. Yeah. So has any market surprised the hell out of you over the last 3 or 4 years, Libby? Or is anything in the markets you've just gone, gee, I didn't see that coming. That's a real surprise post-COVID?
I probably, given that I'd spent a fair bit of my career around the bond market, I was surprised by the magnitude. I think everyone had been anticipating that, we can't stay close to zero in an interest rate setting, policy setting stance forever. I think the magnitude of the rate hiking cycle that we saw following that and the implications for the bond market were probably more than most people anticipated. Certainly that I anticipated. Like I started my career in the early 1990s. So the next worst time in the bond market was 1994. And I thought I'd lived through the worst time. Now I have hopefully, touch wood, lived through the worst period in bond markets. So that was one that did surprise me. And probably more recently, I think, when I was putting together some of this analysis today, looking at that property market, so the listed REITs market, and that's been one that's interesting because there's probably a bit of a disconnect that has emerged between listed property companies and unlisted property companies. We've seen over the last couple of years, probably particularly in the office space, that, I think there's a couple of things going on there. Property markets or properties tend to be valued using the market interest rate, so what's called the risk-free rate. And the risk-free rate has changed from sort of close to zero, sort of maybe 80 basis points to 4 or 5%. So that's quite a lot. And that has meant that the rent stream that they sort of discount back to today's value doesn't look quite so attractive as it did a couple of years ago. And we weren't seeing that adjusted in, I guess, the unlisted market. And I think there's probably late last year when I was speaking with a client about this, we hadn't seen that market fully adjust. I think the listed market did respond quite quickly and probably over-responded to that. And now maybe it's over-responded in the other direction, as listed markets tend to do. But that's probably been one that has surprised me more so than, I think there's been a lot of media attention around the US tech stocks that we discussed earlier, but probably less media attention about REITs, which is not a big proportion of the Aussie market, to be fair. But it was just when I was sort of doing a ranking of the sectors that had done well, financials in Australia had done quite well, and REITs was quite up there as well.
That's quite interesting. I find that fascinating because the financials have done well because of, that's all banking, insurance, etc. But I know there was a big correction with commercial office space, which is listed on the stock exchange because of the whole work from home strategy. Everyone was working from home, but I'm guessing there must be, I'm seeing in the media over and over again that more and more companies, especially the larger ones, are actively encouraging or realizing that working from home full time just isn't going to work. So those office spaces that were empty, you could swing a cat around in them and not hit someone, are now starting to fill back up again, which is therefore bringing investors back into the market and pushing it up from fairly low lows.
Yeah, exactly. And I guess in the financial space, that's obviously done quite well. But I think as interest rates start to bite on some of those borrowers, you might see, I was having a look at the net interest margin, which is what the banks earn over and above, I guess, the difference between what they're lending out and what they're paying in term deposits. And so that's contracted quite a bit over the last little while as well, the net interest margin. So I guess in my previous life, my credit analyst hat is looking at what's going on in terms of people being able to meet their obligations with much higher interest rates, because we did have a lot of mortgages that were written, close to zero. Some of those were fixed for a while and now they've rolled off. I think we are starting to see some pain, probably in the non-bank lending space. We're seeing a little bit more pain coming through in, I guess, the La Trobes and those types of financials, which are not banks, they're not regulated. So just buyer beware on that. They're definitely not the same as banks where you have government guarantee on your term deposit. But that's probably another space that I'm watching. So banks have done well. They're strong and well regulated in Australia, so a little bit different than other parts of the world. But that's probably another one that's done well, but one that I'm watching.
So, Libby, I know every single person that's going to be listening to this podcast is thinking, well, where the bloody hell are interest rates going? Because obviously farmers have big levels of debt these days, and it's a fairly large, interest bills are a very large proportion of their annual expenses. So bringing out your crystal ball, or the whole team's crystal ball, what's Vanguard's estimation of an outlook for what interest rates are going to do over the short to medium term?
So I guess over the medium term, if we're looking out to the end of 2024, we probably think that interest rates in terms of the RBA policy rate, which is what everything else is set around, we probably think that that's going to stay where it is until the end of the year. We've seen the US Federal Reserve, which is clearly a big economy, cut 50 basis points. That was a pretty aggressive cut, more aggressive than I think most people in the market were anticipating. So, but they're already a little bit higher than we are. They've dropped to now 4.75 to 5%, and that's after the 50-point cut. So a little bit ahead of where we are at 4.35.
And they've also got an election coming up in a very short period of time.
Yeah, that shouldn't factor into what Jerome Powell and the rest of the Federal Reserve are thinking, but yes, they do have an election coming up. But I guess they're a little bit further. Their economic picture looks a little bit different. So from an economic standpoint, they're looking, interestingly, our economy is looking a little bit weaker. I think we've had the GDP print, which is the weakest we've had since the 1990s, the 1990 recession. And we've both got fairly strong labour markets. And I think that's something that's the difference. The Federal Reserve has started going, well, inflation's coming down. I think inflation's sort of around 2.5% in the US. So it's getting closer to their 2% band. So they think they've had some success on that. We're a little bit further away. Depending on which measure you look at for inflation, we're sort of 3.5, 3.8, depending on whether you're looking at trimmed mean or the top headline inflation. We've still got pretty strong employment markets. And I think because we're not as close to the RBA's target band, we're probably not going to be bringing down interest rates. We do think the next move is probably more likely to be down in the same way that Canada started cutting, the UK started cutting, like lots of people around the world have started cutting rates. Australia is probably late to the party in terms of rate hikes, and we're probably going to be late to the party in terms of rate cuts. So we probably think 2025 at the earliest before we see any rate cuts coming through. It's really going to depend on what's happening in the data. We are seeing some signs of a softening economy, as I touched on. It's going to depend on what's going on in the employment statistics, but key to the RBA is probably whether that inflation is coming down. And so we've got a little bit different transmission mechanism as well. Interest rates haven't had to go as high in Australia because they flow through to the economy very efficiently here.
Very sensitive.
Yeah, a lot of people have exposure to floating rates on their debt on the mortgage side. But yeah, that's probably flowed through to all parts of the economy already. So that's a little bit different to the US where people have 30-year mortgages. So if you didn't buy or sell a house, you wouldn't have had to refinance at the current levels. Whereas in Australia, it obviously flows. So we haven't gone as high, but I don't think we're looking to see interest rates go down anytime soon, which is probably not what people want to hear. But the good news is we do think the next move is down. The bad news is we probably think it's a 2025 story.
Yeah. And I interviewed Saul Eslake, the ex-chief economist with ANZ back in, I think it was April, and that was his prediction back then was February. So I told him that I'll hold him to that and we'll go back in February and see if he's got it right. And it seems to be a lot of pundits are saying probably early 2025 is probably when we will see a move if we're going to see one.
I think there's a few economists who are thinking we might get one this year. But yeah, we're in the 2025 camp with Saul, I think, on that one.
Yeah. And it's a really interesting thing, isn't it? And we'll start to wrap things up now, Libby. But what I find is there's such a big difference between the way interest rates affect our economy. You know, there's a big chunk of our economy that are highly indebted, and that's business owners. You know, farmers, for example, have borrowed to buy farms, machinery, all those sorts of things. They're very sensitive to interest rates. Young people who are buying their first home or even have bought a home in the last 10 years, very sensitive to interest rates. Then we've got retirees and people that are getting increases in their wages, or people that are closer to retirement that maybe have no debt or very little debt, that have jobs that the wages keep going up with inflation every year, and they've got money in term deposits or investment properties or shares. They're all getting richer when interest rates go up. And then when we flip it around, we get the opposite. So this whole interest rate cycle is really difficult, I'm imagining, because you're getting, some people are getting absolutely smashed, other people are getting rewarded, and then when we flip it around, it's the opposite way around. So it's a really difficult one to try and work out.
Yeah, who'd be a central banker, hey? Like, it's a tough job.
No, not me. I think, yeah. But anyhow, okay, well, look, that's fantastic, Libby. We're all up for time now. Thank you very much for that. Before we go, is there anything you'd like to sort of just say as a piece of advice to anyone listening out there who's interested in the market, who's investing, etc.? Is there a bit of advice or one final thing you'd like to leave them?
Yeah, like jump on, like we've got, as you said, we've got a lot of educational stuff on our website. Every year we put out a series of charts, which is around what's happened in the markets over the last several decades. You can be interactive. You can have a look at how much, you should have made if you've been investing along that way. We've also got some accounts that are pretty easy to set up as well. So I think, you can jump onto, we've got an app which allows you to invest and keep regularly investing. And you can pick the day that you want to invest. There's zero brokerage on that. So you can invest in any of the Vanguard funds in the top 200 shares on that platform. So it can be funds or ETFs. My 21-year-old has just started his investment journey a couple of years ago. His idea of diversification was having 5 cryptos in his portfolio. He's learned a lesson from that, thankfully. And now he not only has 5 cryptos in his portfolio, he's also started investing. And he's realized that for him, it's more efficient to invest in a fund, because then if he's putting $500 to work each month or whatever it is, then it's fully invested. Whereas if he buys an ETF, which is a different type of way that you can access indexing, you're going to have some cash left over basically. So that's a really efficient way. You can even set it up for your kids as well. We've got kids accounts, so that might be something that people want to check out. Yeah, we've got some really great tools. And it's really easy to get started. And there's a range of different structures. Like, it's not just personal, like there's trust structures and stuff that you can set up as well. But you would know that. Had a previous life in doing that as well.
Yeah, excellent, Libby. Well, thank you so much for your time. I know you spend a lot of time talking to the economists and the analysts, and then talking to financial advisors out in the market. And it's been a real privilege for us to be able to have you on here. And I look forward to doing this once a year with you, if you'd be willing to do that. I know we've got a lot of listeners out there that are either in the investing journey or they need to start doing it. So I want to start doing more of these educational talks. So thank you very much for today, and I really appreciate your time.
Thanks, Ben. It's great to talk to you.
Well, g'day everyone. That was an interesting episode with Libby Newman talking about the investment markets. I'm going to go through a few key points, but before I do, I just want to say to you all is, number one, remember the disclaimer. This isn't financial advice. I'm not a financial advisor. I choose not to be licensed anymore. You need to get your own advice. The second thing is, this is not an endorsement of Vanguard. Vanguard's a great educator. They're a big company managing about $9 trillion now. They predominantly do index funds, but what I love about Vanguard and what I'm promoting is the educational resources that they have. So do yourself a favor, go out, have a look at all their educational resources. Just Google Vanguard Australia. There's lots of what they call fact sheets and white papers that you can read. I quite often use most of this to get my market update information. You can see interactive charts to see where the markets have gone if you'd invested, etc. It's a really, really good educational tool, but ultimately you need to make up your own mind where you invest and how you go about it. The second thing is, we talked about index funds, we talked about active funds. I don't care what you do if you invest off farm. Some of you are going to go, look, Ben, we buy, sell and trade shares, and that's what we do. And that's fine. You do you. Someone else can do what they want to do. Have at it. Enjoy it. I wish you all the success. Some people will go, we don't want to do that. We just want something simple and easy, and they pick an index fund or an active fund or some sort of managed fund. You've just got to figure out what works for you and how much time and effort you're willing to invest. I believe that people can be successful investing off farm, whether they do property or shares or something else. You've just got to pick what you're going to do and do it well. The first big takeaway that I got from this is that markets have been good over the last few years. I think she said 15% in Aussie shares, 20% US shares, which is way higher than average. And so what has to happen is markets have to regress back to the average. That's what happens over time. Now, there'll be times when it outperforms, times when it underperforms, but it will always regress back to the average. Now, that average might vary slightly over time, but it will. No different to rainfall. You get a couple of really good wet years, you guarantee you've got to get some dry years in there. It's the same with investing off farm into shares. So the markets aren't going to continue on that upward trajectory. You shouldn't expect that, and you're going to see volatility. She gave the investment returns. The research is showing at Vanguard that Australian shares might do better than US shares over the next 10 to 15 years. I don't know whether that's right. I don't know whether that's wrong. But what I do know is AI is going to be transformative. Like Libby said, I think AI is going to be far greater than electricity, the invention of computers, the internet. I think it's an absolute game changer, and pretty much everyone around the world agrees. So what that's going to mean is there's going to be winners and there's going to be losers. And I use the horse shit analogy in New York during the message. And what's going to happen is, from an investor point of view, you have to be able to know if you're going to pick individual stocks is, how is AI going to impact that company? Are you going to invest in a company that provides, say, makes tires for motor cars? Or are you going to be investing into a company that shovels horse shit in New York that goes broke? Now, that's going to be a big problem going forward, and trying to pick the individual stocks that are going to smash it out of the park is going to be really, really difficult. And Nvidia was one of those. Most people had no idea Nvidia would get to where it was. It just found a really unique space to be in and has done really, really well. So I think that's really important. My number one takeaway for all of you listening today is, for most farmers and graziers or business owners, off-farm investing is critical to the long-term success of your family. What are the reasons? Well, number one, it's a drought-proofing mechanism if it's done right. Number two, it's a diversification to reduce risk overall. Number three, it can help with retirement planning. A big reason succession fails is because when it gets to retirement, mum and dad don't have enough money off farm, so it's really important. But also estate equalisation. So if you've got on-farm siblings or off-farm siblings, it's really important to, if you're going to leave a farm to an on-farm sibling and you're wanting to leave other wealth to an off-farm sibling, if they've got to sell part of the farm versus selling some off-farm investments, it's going to be a much easier strategy. So I think off-farm investing should absolutely be part of your strategy going forward, and you should always get good advice. I can't stress that enough. I know it's hard to find good advice, but you need to get good advice, and you need to start investing now. Start with a small amount. I set up an investment portfolio for my daughter, which I've talked about before. Small amounts compound to a lot over time, and you need to invest an appropriate amount of time in actually managing that portfolio like any other business. So hopefully you've got some great stuff out of today. I learned a little bit from Libby. We've given you some information to think about, but go and have a look at that Vanguard site and look at their educational information and get yourself up to speed. Invest in yourself first to be able to then go and invest off farm. So I'm Ben Law. I hope you've enjoyed that episode. If you have and you think someone else would enjoy it, make sure you share it with your family and friends. And if you want to show your appreciation, jump onto the socials and like what we put out there, or give us a 5-star rating in Apple Podcasts or Spotify. My name's Ben Law again. I'm the Financial Bloke, and I'll see you for the next episode.